recorded. All right. All right, so this is what I thought I'd do. You know, I've talked at a lot of these conferences, and I walk around. We'll try to do it. All right. I talk at a lot of these conferences, especially the securitization, and there are only a few players in the room that can actually benefit from securitization or can actually participate in securitization. But I'm going to go over what it means to the industry, a brief history of the industry, exactly where we're at in the industry, and the opportunities in the single-family institutional space. So we'll talk fast. So first of all, I want to thank Five Star for putting this together. I know in this single-family institutional space, really fast about me, I started as a lender, rose fast, you know, was riding the wave until 2007, and then lost everything and had to give back a whole handful of properties. I'll tell you, our specialty in 2007 was new construction condos in Miami. So I have the downturn, well, you can imagine the downturn hit me pretty hard. So it didn't take a genius to figure that something monumental had changed, and I used my contacts to get a job at Fannie Mae. And I wasn't there long before the FDIC came calling and asked me to lead one of their asset management divisions. It was actually Prescient Asset Management who had the contract with the FDIC. And for years, up until like the last conference I was at, I thought I was somebody special. Oh yeah, they recognized my talent. So I asked the guy that hired me, and he said, oh yeah, you're the only guy that ever heard of REO. So that was kind of where we were at in the market, is that, you know, I went to the FDIC, and the FDIC was similar to the Army after Vietnam, or the military after Vietnam, where they got rid of all of their experts who had combat training. And so when the Gulf War came around, they didn't have any experts, right? So they had to relearn everything. Same thing with the FDIC. They hadn't closed a bank in 20 years. They shut down the RTC, which is the Resolution Trust Corporation that they created just to unwind these banks, and they had let them all go by the time this new crisis had come around. And so what shocked me at the FDIC is how surprised they were for this. Anyways, I'll ramble on. Okay, so at the FDIC, we closed about 150 banks in the southeast, and we, like I said earlier, closed about 23,000 assets in about an 18-month period. And, you know, this was the beginning of the single-family rental space. Prior to the space, just the cost for an institution to come in and buy a property at market level and try to cash flow it just wasn't really happening. So, as I alluded to earlier, this is the largest. The single-family market, or the residential market, is about $23 trillion. So, you know, my numbers are going to be, I'll go through the slides fast, they're accurate, but the others are kind of, you know, don't fact check me. But it's roughly 23 million is the single family space. The investment space is 23 trillion, and it's not participated in by the institutions. So as a result of the downturn, you know, it wasn't just us at the FDIC, it was the Fannie Mae and the banks, is that we had all these. This crisis was mostly single family, right? Not the commercial as before. But we had all these assets, these single family assets. Nobody could buy them. No mortgages were available. So we started bulking them together and then started discounting the price and increasing the loss share agreement until we could start selling these things off. And like I said earlier, it didn't really take a genius to figure out that, you know, a fund was the way to go. So in 2010, I left the FDIC, and we formed U.S. Residential Asset Fund, and we went after it. And I got to tell you, we learned a lot. I mean, I'm not going to get rich off our first trade in the single-family space, but man, what we learned and what we can apply, and that's kind of going to be the theme here, is that what we've learned over the last 4 years and where we are in the single-family space now, we've learned so much. And now that the institutions are participating, they're increasing the efficiencies which are demanded by the capital markets, and those all filter down into our space. So we created a U.S. Residential Asset Fund. We've had that fund for about 5 years. And like I said earlier, now that we're combining with a couple different smaller funds, and we're going to sell off the assets, and we're going to go after with a much bigger strategy. I'll talk about it in a second. So we created a brokerage so that we didn't have to pay the fees, as I alluded to earlier. And we started Prager Intel, which is a joint combination of 3 funds. And, you know, we really only sell off our assets, but we're at a time in this market, which I'll get to in a minute, where, you know, all these funds who started buying these single families are now trying to sell them. And I think one of the most difficult things to do in this space is to aggregate single properties into a portfolio. It takes a lot of manpower. So now we're at the second trade in this space, and there are so many portfolios that when I said that we were selling ours and they asked us who we were using and we gave the story, we had 133 million in literally overnight in SFR portfolios for sale. We still have them. We're actually partnering with Own America to sell them as well. But if you're looking for assets, Vegas, 25 million, Detroit, 10 million, Missouri, Georgia, talk to me, talk to Greg. All right. So we're changing the way, I'll get into this. So the opportunities are not only in the single-family rental space, but the answers have changed across the capital markets. The way that you could raise money, the technology that is available today wasn't available 5 years ago, and so the opportunities across all capital markets are enormous, and we'll get into that. So 506 U.S. Resi, we're kind of changing the structure or the capital raise that we're doing right now. This is a 506C offering. For those of you who don't know what that is, this is a crowd-funded offering. It's just a new exemption to the 506 rules. This is a C where you're allowed to solicit for an offering, which is revolutionary in the private placement world, I guess. And we'll talk about it in a second. Next, we created Investor Valet, which is a crowdfunding portal, but it's a little bit different than most of the portals out there, is where we don't just list syndicators, we bring them onto the portal and they partner with us to sell it. So that's a little bit about me. So I've been involved in this space, since the beginning, at the FDIC, at Fannie Mae, and we really saw the creation of this space. So what I want to do is, I'm going to go over a history and then get into it, but I put these slides up here. You can all request a slide deck, and I recommend you do it, and I'm going to show you why. So my presentation is going to show you where all of the opportunities are in the single-family space, made available by the securitization. If we've got the big guys at the top, it affords more exits for everyone else. But we'll get into it for a second. So let's go to slide 2. So we're in a renter nation. I'm 40 years old. Well, 5 years ago. I'm 45 years old now. And boy, my entire life, all I heard about were the baby boomers, right? Baby boomers, pig and python, moving through the right? And then all of a sudden, about 3 years ago, I heard about the millennials. They're even 20 million bigger than the baby boomers, right? So they say that we're moving into a renter nation where we have more renters than we do buyers, and this is a representative slide. Now, I put these up here so that you can have something to present to your clients, so you can have a better understanding. But where we were during with the Bush era is that home ownership was American way, right? We increased home ownership to roughly the high 60s. I think that normalization should be in the lower 60s, right? We're deleveraging into the lower 60s and below. So we've got all of these households that it's really the tightening of the mortgage credit that is the inability for people to buy homes. And so we see that the household formation is down. And largely because the millennials are not participating. We'll get in. What I think about, everybody says that the millennials are different, that they're not owners, they'll rent, whatever. Look, you can map out someone's life curve, and whether it's delayed by a crisis or not, eventually they fall into normalized trends, right? Whether it's 23 or 35, they have kids, they're a first-time home buyer, so on and so forth. So we'll get back to normal recovery, and I think that we'll move out of a renter nation, but we're in a renter nation right now. Let's go to the next slide. U.S. household income levels. So one of the reasons why we're moving into a renter nation is because nobody can afford a mortgage, right? Everybody says it's difficult to get a mortgage. That's not true. It's easy to get a mortgage if you qualify, but the credit standards to qualify for a mortgage, combined with the student debt, is really making it difficult for people to buy a home. Anyways, we see that there's a big decrease in the annual household. Prior to the downturns, 2/3 made $70K. After it was 150. Next slide. Single-family rentals are being absorbed rapidly. Look, the reason why we're having a boom in the single-family rental market is because there's so much demand out there for single families. And we'll talk why single families make a great rental. Look, so if you look at a multi-family portfolio or a multi-family, they're typically comprised of 1-1s, 2-2s, close to the urban core, right? Very few 3-2s. So when somebody graduates out of, they get a kid or they have a family, and they don't want to own a home, where do they go, right? Prior to where we're at now, there was really no place for them. We'll get into that. High demand, next slide. Total single family rentals available. You can see here, next slide. We'll get through these really fast. This is a percentage of U.S. rent. Let's go through the next slide. Let me go to the next slide. I'm going to get to the one slide I want you guys to look at. The next slide, it should say top 18 institutionals. Is that where we're at? Yes, no, maybe? All right, good. So I put this slide in here for you. So this is a little bit old. Where we're at right now is that in a maturing industry that everything consolidates to the cheapest money. And I think Sonny said that, 2% cost of funds? That's ridiculous, As interest rates start to increase, by the way, higher efficiencies will be demanded and be created, which will lead to even more opportunities. So, this recovery has been in primary and a little bit secondary MSAs or cities, right? But there's still a lot of juice to be squeezed in the tertiary markets. And, look, I got 10 million homes in Detroit. It's not that easy to sell them. So as the efficiencies are created or demanded by increasing rate and higher cost of funds, it'll open up more markets that can be participated in by renters. Anyways, here's why I'm showing you this. Look, the number one thing that this goes for you guys about securitization, if you're not a fund looking to participate, look, let me tell you that if you get a loan from First Key, B2R, on the single family portfolio, you're participating in a single securitization. That's what they do with them, right? That's a multi-borrower securitization, right, Tony? Yeah, all right. Shake your head yes or no if I'm off, by the way. That'll be fact checking. All right. I put this up here because these are your exits. Look, the better they do, right, the better we all do, right? They rise up the market. So look, I put their name on there. Look, combine this with LinkedIn. I mean, you can find anybody you want this day and age with social media. So if you've got portfolios or if you've got, you want to get into the space and don't know where to go, look, start talking to these guys. Get on LinkedIn. They're in every city around the country, by the way, by now. All right, go to the next slide. All these slides, by the way, I went through these really fast because you can look at them on your own time, right? I think that, the last slide that we had is a gold mine for anybody that's in this space, that's looking to be in this space, that wants to contact the biggest institutions in this space. And there are some that I think that I left off. Those are, actually I stole these slides from Dennis from First Key, so he put them together very well. I asked him if I could do it, by the way, so he said yes. Well, he will say yes. All right. This is all leading to the perfect storm for sustained growth. Look, everybody's trying to question, for years. So, I remember at the FDIC days, 2007, 2008, what was the question? How long will REOs last, right? Then all the REO agents went into the investment space. How long will this last? Well, who knows? I mean, look, we're in an artificially suppressed interest rate environment right now. Trends are good. You can see from this slide right here that we're in a perfect storm for sustained growth. I could say for the next 5 years, all looks great, and we'll check back in then. If I had to put a number on it, I'd say we're in the third inning, right? It's not too late for you to get in. With the way the markets are going, and we'll talk about it in a second, you can, before you'd have to get in buying one-offs, two-offs, do the rehab, build up to 5, build up to 10. Long process, got to bring, right? Now there are performing and non-performing portfolios. Look, here's the thing about this space is that a lot of funds were created. There are a lot of funds out there, and not all of them are doing well. You can still, there are a lot of funds out there. This is a very difficult asset class to manage and make money on, especially in the second trade, right? And there are a lot of funds out there. We've got discounted portfolios from third parties. Okay, only got 5 minutes. Anyway, so go to the next slide really fast. This is a great slide for securitization if you want to understand how it works. All right, go to the next slide. This goes into the spread versus insurance data comparison. I'm not even going to step on your toes, Sonny, by the way. So let's go back to the first slide, and I'll wrap it up here. I got 5 minutes to go. I didn't even get to talk about most of it, but that's okay. My job here is to get you excited about the opportunities here. Look, this is a $23 trillion market that's just now being institutionalized, right? Institutionalization means you know, the guys, really intelligent people, are coming in here to figure out how they can make as much money as possible. Typically, this market was mom and pop investors, right? 5, 10 homes. And by the way, there are 14 million rentals in the U.S. Only about 200,000 are institutionally owned, right? 14 million out of, how many homes are there? 80 million in the U.S., something like that? Roughly 80 million, 23 trillion. So there's so much room to go here. So the institutionalization, tell me when I'm done, by the way. You can just go. All right. The institutionalization, so these institutions don't, the way you create efficiencies are policies and procedures, training, you know, data reporting is a huge thing when it comes to securitization. But as they create them and all of the experience that they learned in the last 4 years, it doesn't stay with these institutions, right? I'll tell you a secret. Can't leave this room though. Is it so? I was hired at the FDIC to create we had to create their asset disposition plan, and you know they didn't have anybody there, and I just left Fannie Mae, so I took their manual, converted it to the FDIC. Now the FDIC uses it, right? Same thing in these institutions, right? As they get more efficient, it trickles down and it shows and it teaches other people to be more efficient, to make more money in this space. So there's so much opportunity here. Let me go over really fast the opportunities as I see it. Look, we could say that this is in the infant market because in a mature market, deal flow is typically the constraint. In this market is capital. You know, I talk to 1 million wholesalers all the time, and every one of them said if they had as much money, they had, you know, another 20 million, they could buy as many properties as they want. Everybody in this space, once you get efficient in acquisitions and bringing them into your portfolio, the more money you can get, the better. So as we go through securitization, look, so if you're not an investor, you're flipping it around, look through, you know, all of these rating agencies have operational risk department. They go in and they certify or verify all of the vendors that they use, from BPOs to property managers to field service and so on and so forth. You can talk to Sonny here about that. Look, go get yourself rated as a property manager or as a whatever. I mean, there's a tremendous opportunity there. This is only going to grow. What else? I think I think that's it. Let me give you something to write down if you want to really learn about this asset class. So Oliver Chang from Sullivan Road Capital, just search Oliver Chang. I think he was the head of markets for J.P. Morgan, and he wrote these white papers on this space in 2007 and 8, and there are about 5 or 6 of them. They're highly technical, but man, it really lays out the play in this space, and I'd recommend that you download it. Go talk to Greg Rand. He's been in it since the beginning. There's another guy, Gary Beasley, that's here. I mean, he founded Waypoint and I think Exit Realty, and now he's doing another startup. You've got some big guys in the room here. They're here to meet with you. They're here to talk with you. So this is a great conference to meet them, to understand the opportunities and your place in it. There's tons of room to grow. You're not too late. And that's it. All right. Thank you very much.